Hey everybody, we're just gonna wait until some more people trickle in here. A couple more minutes. But everyone's having a great afternoon here. Looking forward to diving in here shortly. And to start things off here, curious to see what kind of softwares everybody's using. So um, I guess maybe starting with the project management softwares, if anyone's using any of those softwares like Builder Trend, LMN, Synced Up, JobTread, Single Ops, Jobber. Would love to kind of see what everybody's using, and if not, would love to kind of hear what maybe even what accounting software if you're not using any of those that you're kind of tying everything together. Awesome. All right, some QuickBooks Online, LMN, very nice. Build a trend.
Hey, good evening.
All right. And for those of you that are just joining, we're just trying to get an idea of what softwares, whether it's field management or field management softwares, or maybe if you're just using QuickBooks Online. Right. Very nice. Well, super excited for today's presentation, and many of you may have been in some of our previous webinars, and we typically focus it on all companies within the green industry. And I think today, when Carl and I were thinking about, based on some of the questions that we receive, is how can we better better help maybe some of the contractors in regard to with these webinars, maybe that are focused 100%, or maybe have a big part of their business that is more of that installation based, using a lot of material, whether it's hardscape, outdoor living contractors, outdoor construction contractors, because there's a certain aspect of that is very different than the way that a lot of companies operate in regard to maybe some more of the recurring services or maintenance. So, and I would say that there are great benefits to these service lines. But the other side of it, I think it just makes managing cash flow a lot more important. It's something to definitely prioritize. So really, really looking forward to today. For those that are not aware of Cycle CPA, so I'm one of the co-founders, Joe, and we're a virtual accounting firm that serves companies, mostly green industry companies throughout the country, and a couple hundred companies. And this is really our focus. And we have a fully remote team, everything from bookkeeping to advisory, CFO, all the way to tax services as well. And I have here along with me Carla Policastro, the other co-founder, one of the CPAs here too.
Hi, so nice to see you all and to join you all today. Like Joe said, I'm super excited to really talk about the intricacies when it comes to the hardscape and outdoor construction area of the green industry, just because I do see a lot of value that we could bring to the table, being involved in a lot of these meetings that have to do with like cash flow, forecasting, and budgeting on that side. I just feel like there's so much to be able to strategize on that end a little bit more so than the recurring work. And so super excited to break some of those items down for you. If you guys have any questions, please ask during the chat. and this will be recorded as well.
Awesome stuff. And today we're going to go over job costing processes. We're going to go over accounts payable, really digging deep into the AP, and implementing a process that really works for that. Also, something that really goes hand in hand with the accounts payable is mastering the weekly cash flow, right? And for those clients that we even work with, or even if you don't have an accountant, right? We recommend at least a weekly or bi-weekly meeting there. And then also we'll cover some of the benchmarks to focus on, as some examples in regard to things to look into there. And starting with job costing, I guess to kind of start, those that are not as familiar with it, really what it is you're looking at profitability for one specific job. So almost instead of, looking at your company and looking at maybe a profit and loss statement for the month or for the year, you're almost looking at a mini P&L, that shows some of your or all of your costs and all your expenses associated with that specific job. And why is that important? Because it'll give you ultimately a quicker feedback loop. So instead of waiting until the end of the month or end of the year to see how you did on that project, you can often see it, as soon as that project is finished, right? So it really helps to make those adjustments where needed. And when it comes to some of the project management softwares and CRMs, I know many of you had kind of listed out some of the ones that you utilize. A big part of this to keep in mind, and something that we see very often, is companies track some items, but they don't really tie everything together. So it ends up becoming almost like a waste of time, right? To kind of have a half-done job cost report, because you can't really make decisions based off of that as much. So we recommend that if you're going to job cost, try to stick to the processes, stay on top of, whether it's tracking time, right? Making sure that you're holding your team accountable, making sure that you're collecting receipts, or even if you have an app in place in regard to making sure that your accountant or your internal team has that information in order to categorize some of those transactions as well. And then also utilizing QuickBooks Online. So you're utilizing multiple different softwares here.
Yeah, and as Joe mentioned, you may be using, I see some people wrote in the chat, you're using QuickBooks Online, you're using Element or JobTread. And the hard part becomes marrying all of those technology stacks that you have together so that they can give you the insight that you're looking for. And so, people say, well, do you know your numbers? What does that actually mean? It means utilizing your numbers and making better decisions. But in order to have that, you need to have that data collection, like process, automated, and having everybody talking to each other like a married couple, so that could be successful in a relationship, right? And so I think that's really the biggest disconnect that I've seen in the industry is you guys are doing a great job maybe tracking your time, tracking materials, utilizing QuickBooks, but then it's like, all right, cool, I have all these metrics everywhere else. How can I bring that all together? And so Joe and I thought that it would be great to show you guys a real life example of one of our clients who we implemented job costing for, use their tech stack they had in place to really give them that job by job insight. And I'm super excited to show you guys what the journey was, but then what the outcome was too. So it's a $2 million landscape install-based contractor. And, the description is that they were having problems tracking and controlling the project costs in a timely manner because they didn't have the processes across their employee lines to be able to, to track time, or didn't know how to collect receipts. And that led to them running overtime or just not billing the project on time. And so that led to cash flow constraints. And, you've probably heard it all, but that's really was their main issue. And so this really impacted the company as they grew, because it reduced the profitability in 2023 by 80%, which was really big and detrimental to them. So that decline in cash flow led to them not having enough money to fund their operation. And then they had to take out a big high interest rate loan to stay afloat for the first quarter in 2024. So as you can see, if you don't have the processes in place to do a few of these things, then it could lead to other items falling through the cracks. But let me introduce you to the platforms and tools that they use, right? So first, they use QuickBooks Online, which is great, right? So that's where us, Cycle CPA, we did all of their accounting work. Gave them the profit and loss for their entire company, reconciled, all that good stuff, gave them tax ready books, items like that. Then they had a designated email where we set it up so that we could pull the receipt for each specific job. So all the receipts for all the project costs, so materials in the company, were all getting funneled to this one email. So all their vendors knew, okay, I'm going to send material receipts to this one email, their AP email. The next thing is the client already had a CRM. They were using JobTread. So that made it easy for us to implement other processes, which I'll dig into deeper, but they were utilizing JobTread already to submit bids, track time, and manage the project budget as well. They were also using it to schedule jobs. And then we at Cycle have a job costing spreadsheet template that we use to kind of take all the data and pop it into one beautiful report for the job cost. And that's kind of the final product. So data collection, like I said, I'm just going to keep beating on this horse, is super important because, right, we like to say garbage in, garbage out, right? We want to manage the data as easily as possible. So we want to utilize software that has a two-way sync. That means what's in QuickBooks Online also syncs over to the CRM JobTread. So JobTread has this two-way sync where QuickBooks talks to JobTread, JobTread talks to QuickBooks. So that way we're not duplicating data entry work and wasting time on things like that. So that was a huge part of this, is that JobTread had that capability. All right, so we were talking about categorizing costs. Remember, all the receipts were getting funneled to this one email. So this is an example. We would get an invoice from, this example is from the Deck Superstore. And this vendor here, the Deck Superstore, would always put the job name that it belonged to. So the job name is Crystal Bartlett. So that was super important to communicate to your vendors and say, hey, I don't want any invoices going out without any project attached to it. And that allowed us to then see this invoice that came through the email. And then when we saw the corresponding expense that belonged to that, we're able to, okay, this is job site materials from the Deck Superstore. What project is it going to? It's going to the Crystal Bartlett project, right? So it allowed us to be able to allocate all the project costs to the specific client.
Yeah, and for those that are not as familiar with QuickBooks, that bottom screenshot is from QuickBooks. So within that function of the project tracking, which is the highlighted aspect of that as well.
Thanks, John. All right, so we talked about two-way sync capabilities. So like I said, so if we put these amounts into QuickBooks, then it would also tie it back to the Superstore expenses here on JobTread, which made it super easy for us to reconcile. Okay, JobTread says that there are these expenses that came through for the Deck Superstore. Now let's reconcile that to QuickBooks and what actually went through the bank account. Again, over here down below, you'll see like payroll expenses. So because they were entering in their time into JobTread, tracking their time for their laborers, then we're able to take that time and then they were able to run payroll for their company. All right, so the final step in the job costing process is to transfer all the direct costs. So the direct cost of a project is, here, let me show you, is material, labor, subcontractor. For this particular client, they wanted their direct costs commission as part of their direct cost. That was something unique to them. That may not be the case for you. Equipment rental, which is standard. Again, sales commission, they just wanted that as part of their direct costs, design and engineering, disposal costs, and then building permits. So we over here, this profit and loss by customer, we were able to export this in QuickBooks from QuickBooks. So this is a QuickBooks report here on the left. And that's, remember when we were categorizing all the transaction under that client's name, and then we were able to get a cool report like this. But this is the problem. It only shows up through gross profit. You see that we have the revenue for Crystal Bartlett, and then we have all the direct costs, right? But again, we can only see the gross profit, which is the revenue minus all the direct costs. So for this project, it was 9,416. But the problem is that we want to see the project's net profit after overhead expenses. So the overhead expenses are missing for this project. So we need to export this from QuickBooks, and then we need to allocate overhead expenses for that month. So for that, it was that 7,600 about number. And then that's why we have to use a separate Excel sheet to put that number in there. And then we sent this off to the business owner, and then we review, okay, so on this job, we made only 7% profit. And then like you see, you know your numbers, right? Why did we only make 7% profit? Because you know your numbers, you can say, wow, you know, I spent a lot on subs, 27% on subs. Okay, what happened with my subcontractors? Did they have a lot of change orders? Did they run overtime? You know, was I not, did I under budget for this job, right? So now, because you know the numbers, you can go back and see exactly what happened there. So there's this, so you're going to ask me, okay, like, where did you get that overhead expense number and how do I find that? Because it's very like complicated. It's not very, I'm sorry, I meant to say it's not very complicated to get that number. And so here's the step-by-step procedure on how to get that number, but let me just show you here. Again, this video will be sent out. So if you wanted to read, I just find that it's better if I just go through it through here. So how we get to that overhead allocation number. So again, overhead are all your indirect costs that your business incurs. So your salaries and wages, overheads for your managers, your office staff, your marketing and advertising, your rent, your telephone bill, all of those costs that are just normal operating expenses that are not direct costs. Okay, so first we go, and what we do is we pulled the total hours worked on this job. So it was 106 hours that we worked on the Crystal Bartlett job. Then we say, okay, well, what were the total hours worked at the company in May while we were completing that job? And it was 864 hours that we had of field labor hours. So then what we do is, okay, as a percentage, what is 106 as a percentage of 864, right? So what did Crystal's job make up of the total hours spent in the field in May? Well, Crystal's job made up 12% of our time, of our company time. Okay, cool. So we have that 12% number. Then we take the average monthly overhead cost. And you always want to take the average monthly overhead cost, not just the overhead cost for May, right? We want to take the last at least 12-month average of your overhead costs, right? Because we want to reflect like almost a full year, because you may have, the reason why you want to take like an average cost over the 12 months is because you may pay your insurance for 6 months, and that may not hit until like July. And if you only took May, then that wouldn't reflect your total overhead cost. So you want to just take the average. So anyways, the monthly average, if I took my total overhead costs for 12 months and I divided it by 12, I'm going to get my monthly average. So that's 62,000. Okay. So then I take my 62,000 and I multiply that by 12%, because that's how much time we spent on Crystal's job. And then I can get, okay, cool. I have my overhead percentage, overhead dollar amount that I can allocate to Crystal's job. So that was about 7,600. All right. And that's really a really fair way to allocate overhead expenses. So here we have the final presentation of the job cost report. And I don't know if you guys can see it. It looks tiny on my end, but it was just the same thing. So we allocated the overhead expenses of 7,600, and then that decreases the net profit to 7% of the revenue for profitability there. Okay, cool. So once we implemented the job cost reporting for the job cost for this client over 2024, we saw that there was more precise time tracking and expense management for the company, because now they had these processes in place, and every invoice had to have a name for the job. And, and while I'm presenting this, I feel like it feels like all of this went through very smoothly. And it didn't. It's not a smooth thing. I just want to put that expectation up front. Like, it took 3 months of us ironing out the kinks in order for this to work. It's not an overnight thing, but you have to put it in place in order to iron out the kinks. Don't get stuck in analysis paralysis. Like, did we have to call vendors and tell them, oops, you forgot to put the project name into that? Yes, we had to do that. We had to remind vendors. Did we have to remind employees? Did we have to keep employees accountable? Yes. Did we have to keep our overhead staff accountable? Yes. Our managers accountable? Yes. And that takes time, and it takes some sort of incentive, right, towards them. Like, do they get a bonus? Do they get a holiday party? I don't know, right? That's up to you and your culture. But yeah. People were very motivated to make this work. And so was it a smooth process? No, but we got there, and now it's been, now it had been a year since we put it in place, and we were able to see the financial dividends that it paid. But anyway.
And yeah, Carl, and that's where it kind of differs from maybe some more of the traditional accounting services, bookkeeping, even the advisory aspect of our services at Cycle CPA. But even just, I would say within any accounting cycle, it's, I think just having that expectation, as your company grows, and if you want to dialed down into job costing. It's not as much something that as an accounting firm we can really just come up with these reports based on a lot of the stuff that we perform. It's more of we can help to really coordinate and help bring it together. But a lot of this will rely on your team, as Carla mentioned, making sure that you are, performing some of the steps here.
Yeah. And let me get to the good part because I've been waiting for this. So the revenue in 2024 increased by $220,000. But better yet, the profits increased by 224%, which is mind-blowing. And I hope that it brought to light, yes, there's a lot of steps involved and we can help coordinate that, or you can get your accountant to help coordinate that, your bookkeeper. And you have to work as a team. But in order to increase profitability by 224%, I think it's all worth it. Knowing your numbers to that detail, in being in business and knowing what you have to bring and really dialing that in is a powerful tool for you.
And Carl, we have a question by Jeanette. Are you using purchase orders to keep track of the expenses?
Yes, in some systems we use purchase order to keep track of expenses. All right, so let me dive into accounts payable. So accounts payable is, it involves managing your short-term liabilities. And what that means is paying your vendors that you owe in the next 6 months. So this could be Site 1 is an example. They have terms of 30 days, 45 days, right? Your sales tax, you have to pay that every month or every quarter. Your payroll, that's short term, that's due, but not long term, like loans that you have outstanding for 5 years or something like that, right? It's the short term items and what you owe to others. And accounts payable plays into a big part of your company, because if you don't manage your accounts payable right, then your cash flow is not going to be managed right, and therefore you can hit some low cash flow months, and that could be detrimental to the business if we're not managing that correctly, right? Because it deals with paying people out, and you want to do that thoughtfully and strategically. But in accounts payable, there are a lot of opportunities. So whenever I say accounts payable, people think, oh, paying bills, that's super easy. I can pay my bills. Of course, you can go and you can log on to online, the vendor portals and pay your bills, or paying on the phone, or have it automatically withdrawn from your account. But that's not what we do. I mean, that's very simple, but the value that we're bringing to the table is that strategy part, the strategy of managing your cash flow and making sure that you never have those dips, making sure that you're never thinking, am I going to meet payroll? Am I going to have enough money for this winter season in order to cover my fixed costs? It becomes more than that. And there are some big opportunity areas when it comes to accounts payable and how to manage your cash better. So if any of these resonate with you, then I definitely would encourage you to look into some of these items. So if you're consistently carrying a high balance on your credit cards or line of credit and struggling with cash flow, then this may indicate that you need more of a structured, strategic process to accounts payable. If you have difficulty paying your bills on time, or leading to late payment, or maybe creating this frustrating relationship with your vendors, limited in-house financial expertise. Maybe you do have an office employee or bookkeeper, but they're just paying the bills blindsided, right? Maybe they just blindly is what I mean to say. Maybe they just know, okay, I have they have this like snapshot. There's 10,000 in the checking account today. Oh yeah, we can go ahead and pay vendors. That can get you into trouble because it's not telling you the whole story of the company, that next week you owe payroll. The week after that, you have to pay your 6-month insurance bill premium, so that's the kind of, viewpoint that you don't want to have going into this. And then, of course, if you're growing your business and you're growing it really quickly and there's a lot of decisions to be made, that's when you could also be struggling to manage cash flow and need additional help.
Yeah, and if you're not growing to that point, or if your company is not to the point where this has become a bottleneck, or maybe there's just a few bills each month, this may not be something to maybe put a huge priority to. But ultimately, if you grow, this will become something, especially when you think about one of the bigger items as well. And I know Mike R mentioned it too, just how this can impact cash flow. And absolutely, I think when you're thinking about accounts receivable and the speed at which you're collecting payments from your customers, you want to make sure that you're ultimately never paying bills quicker than you are receiving, right? So it's those are that's also one main thing to keep an eye on as well.
Yeah. And in order to make sure you have a good pulse on your accounts payable, make sure that you have clean accounts payable, so clean data. On your QuickBooks, if you go to accounts payable and you have like old vendors in there with old balances, just make sure that those are cleaned up before you continue with your accounts payable process. Because if you have old balances in there, then that's not showing your true accounts payable process amount. And then create a debt schedule. Know when like your T-Mobile bill is going to hit. Know when your insurance bill hits every month. Know when you pay rent every single month. Because if you know what dates those are going to get debited from your bank account, then you can have a good cash flow forecast, which that's what we're really gonna get to in a second here. And we utilize Bill. I know I have bill.com, but now it's called Bill. And it has really been a great software to use for paying bills to vendors, because almost every vendor is on Bill now. And Bill even issues checks for you. So you don't have to write out checks anymore. And they will issue and mail those checks if like your vendors are not on Bill, making it really easily and streamlined for you. They will, when we set you up on Bill, we also send out invitations to all your vendors like, hey, Scape Cycle is on Bill and we're going to be using Bill to pay you now. Please sign up with us. And we'll get that all coordinated with your vendors so that way they are on Bill and we can just easily pay them through there. And the cool thing about Bill is like, we have this, as an accountant, I have to talk to you about this, is security, right? It has an approval process. So we're not going to just pay your bills willy-nilly and, not get approval from you first. So we're going to enter all the bills and send, and on the software itself, it's going to tell you, hey, Cycle wants your approval to pay these bills. And you're going to do a quick, visual check, approve. It's going to get back to us. And then we process the payments to those clients. Because sometimes it happens where they say, hey, Carla, don't pay that bill because I already sent a check to that vendor. They were just really wanting me to pay them before our check run. So, things like that happen, but also for your security too. So like I said, we don't want to just pay bills. We want to be intentional about what bills we pay so that we can have good cash flow for the business. And we can do that by creating a weekly cash flow forecast for the business. And so let me just get that pulled up and I'll share my screen and we'll go through the forecast here.
Yeah, and as Carl's getting that pulled up, so Jeff had the question: is machine maintenance considered overhead? So we typically don't include any sort of maintenance within cost of goods. So yes, it would be considered overhead expense. And at Cycle CPA, we do have a recommended chart of accounts for green industry companies, but the most important thing with the chart of accounts is over a specific period of time, you want to stay consistent, right? So that's really one of the more important things, So if you're consistently putting things, within overhead, I'd say leave it within that section. Because there's always going to be some borderline things. Some people might recommend slightly different chart of accounts, but try to stay consistent with it. But yeah, so any sort of maintenance is typically within overhead.
Joe, can you see my screen?
Yes.
Okay, cool. So this is a cash flow forecast. So why is this important? Because the ultimate goal is to increase the cash in your bank account, right? And if we're job costing, we're like 75% of the way there. But what's really going to get us there is managing that cash, right? That cash that's coming in and coming out. We have to manage it in a strategic way. So right now, this is a 4-week forecast here. As you can see, each week ended in that particular month. And it starts with the opening balance in the bank account. So for September 18, 2024, we actually get this number like on Monday mornings, and we put, okay, Monday morning, we started with $120,000, right? So this is going to go through next Sunday or whenever. I think this is actually yes. Okay, so next Sunday, right? So then we say, okay, well, according to the projects that you are going to be on site on this week, or projects that you took money down on, or your accounts receivable, this is how much we project that you're going to deposit into your bank account this week. So for this client, it was $10,000. How do we get that information? From your AR report and from your CRM. So if you're somebody that uses LMN, we'll go in there, we'll see like the projects that you have scheduled out, the progress billing that you have, and when we could expect those funds into your bank account. And that's how we project out these amounts. So we have that money coming in. And of course, like if you have a recurring revenue on the side, like you have maintenance contracts or anything like that, that's super easy. We know how much each month that comes out to be approximately. So once we have the money that's going to be projected to come into the account that week, we have to project the money that's going to be coming out of your bank account that week. Because we're the ones that are going to be paying your bills, we know that, okay, we need to pay $8,000 to this sub because the bill is coming due. They're not wanting to extend their terms till the next week. So we really need to prioritize this $8,000 subcontractor expense. Then we make payroll transfers for you. So we want to make sure that you have a bank account specifically for payroll. We don't want to intermingle your normal operating bank account with your payroll. We want to have two accounts because on average for this company, they have $41,000 that comes out each week for payroll. So we're in charge of transferring that money to make sure we have that money set aside for that week's payroll run. So that was that. Then this client has a goal that they want every Wednesday. They want us to transfer $500 to their money market account as a safety net, as savings, as their winter emergency fund, etc. So that's what we do on every Wednesday. And then we have direct cost bills. So what is direct cost bills? I'm going to show you. So we're going to look at the AP aging. So this is the accounts payable for this company. And you can see all the vendors that they use. You know, they have nurseries, they have Alter, different vendors in here, right? So that is obviously all their material costs that we need to pay for this month. And you can see, okay, well, this company has a lot like past due, 91 days, 61. There's a lot of bills that are past due. So you're like, okay, we're not going to pay all of that. This is what I'm saying. We're not paying all of that. The yellow is what we prioritize to pay. Like we may know that Allturf, they get a little angry when we're like over 90 days past due. So that's whenever we'll strategize to pay that vendor. And this is an example of a business that we're having to prioritize who to pay because there's not a lot of money in the bank account. Okay. So I wanted to use this as an example because maybe there are some of you that are in that position. Like in order to have like really strategic meetings and have accounts payable, you don't have to have like an overage in your cash account. We do help companies strategize if you're hitting a low month with cash flow. Okay, these are the vendors that we should pay. Because we're going to need to order more materials from them and they're getting a bit angry right now or whatever, but or who we want to maintain a good relationship with. But this is a real life example, guys. That's that. We're paying $10,000 in vendor payments this week and XYZ invoices. So then we go over to your overhead expenses. So legal and professional fees, like all other costs that are not associated to jobs, Wells Fargo looks like. And then we go down to your balance sheet items. So this is what's important here or something that I want to point out because the balance sheet items don't show up on your profit and loss. So this is what makes this a cash flow forecast and not a profit and loss report.
And Carla, just to kind of add on to that as well, I think even what differs from even a job cost report too.
Right, right.
So this is some of those liabilities, loans, these are, and this is oftentimes, I think when companies are even making a decent profit, this is where sometimes you can kind of look at your bank account and say, okay, why is there not as much cash that I want? It's
Right.
because of some of these items and also the timing of some of those balance sheet items.
Yeah. So the balance sheet items being the credit cards that we have to pay, the loan to like Cheffy, all of that's not going to be on your balance sheet. And here you can see the credit card balances and what they were. We want to know what the credit card balances are each week because again, this company is facing a cash flow constraint. So if we're saying, okay, well, these are all due, but which one are we going to prioritize? Probably Amex because they have the highest interest rate right now getting charged to our client, which is 29%. So we're going to try to pay them off and try to pay them every week consistently. So that way we don't incur those interest rate charges, right? So it's important to have that insight. And this is what I'm talking about when it comes to strategy. So anyway, you see up top, they started with 120,000, but at the end of that week on Sunday, the projected balance, the forecasted balance is 63,000. And I just want to tell you guys, so that went down by like almost half. And I just want to tell you guys, this is what I'm saying. If you're making gut decisions based upon your bank account balance today, and you're not looking at the next 4 weeks, the next week, it's like you're inevitably going to manage that incorrectly because you're not going to have the full view of what your cash is going to look like, right? Here we have a positive week, 15,000, good. But now we start going into the negative, like October, the first 2 weeks of October. What does that mean? That means we're projected not to have enough money in the bank account to cover all of these expenses. So what are we going to have to do? The first 2 weeks of October, maybe use a line of credit. We're going to have to book more jobs, a combination of things. We're going to have to put off vendor bills, right? That's where the strategy comes into play and we get the visibility ahead of time. So we're going to, strategize how do we not let this happen, right? How can we prevent that from happening? So that is what I have on the cash flow forecast here. Let me stop sharing my screen, and I'll let you take it over, Joe.
Yeah, and if anyone has any additional questions, definitely mark it down in the chat. Carla, looks like we have some more questions actually.
Yeah.
So how do we recommend managing cash flow during the off-season months in Hardscape work, especially when projects slow down but overheads remain fixed? So I would say one of the bigger items with that, Mike, is really understanding that when you look at the bottlenecks and the potential things that can go wrong with the company, I think cash flow is one of the major aspects, and seasonality adds a big variable to that. And one of the biggest ways to deplete profits and cash flow is to maintain too high of a fixed cost during the off season. And you don't want to do that to yourself. You work too hard during the busy season to make that happen. So even if you have to, and there's a couple of different options, right? So you can add on additional kinds of service lines for that purpose, which we have companies do all the time. If it's going to allow you to continue to grow and continue to get past some of the slower seasons in the winter months, add on another service line. Or maybe scale back and scale some of those costs back more, right? So be a little bit more realistic with that aspect too.
Also, we would, in order to really give you an answer to that, we would also analyze the cash flow cycle of your business, because your business may just have a slower season, October through January. I don't know what the months are, but if that's the case and you don't really want to add on another service line, or maybe there's not a lot of opportunities to offload some of those fixed costs, then what we would do is project the profitability that you need to keep in the months that you're in operation to create that nest egg to cover your winter off months, right? So that means we just need a bigger profitability during those months to cover the off season. Another thing, maybe we need a line of credit to pull from during those off months that we expect to pay back during those really positive months with cash flow, right? Or it may be a mixture of both of these plans, but when we diagnose and really dive in and we make a plan, you'll be able to see it very clearly in what is needed. And some people, like Joe said, just really need to add on another service line, and that may be just the only option, right?
Yeah.
But it just depends on your business model.
Yeah. And maybe that additional service line, maybe you're actually just subbing out a lot of that because you don't necessarily have the expertise, but you have the list of other past people that you've done projects for, right? That already trust you, that will already kind of work with you in regard to that. So definitely leveraging that.
David asked, are the inflows of the cash flow projected net of sales tax? So no, they include sales tax, but the sales tax, it's not net of sales tax because the state doesn't take the sales tax off right away. Like you get the money in, you don't pay the state until quarterly, or you don't pay them until monthly, depending on how you file sales tax. So you want to include it with the sales tax, but then in the balance sheet section, remember, you can put sales tax payment and when is that projected to be paid out. That would be in the balance sheet section. It's a great point, though.
Awesome. And, as we get some of this data together, now we can actually, really understand, okay, how do our metrics measure against other companies? Or, what does a profitable company look like when it comes to some of the data and some of the metrics? And really the goal is to go all the way from taking all this data, all these metrics, and funneling it down to what's called key performance indicators, also known as KPIs. Really, it's just those metrics that are the most important to look at, that are really going to drive the financial health of the company. And whether you're looking at companies, in the current year as a percentage of total revenue, so looking at the column all the way to the left, and then comparing it to the previous year, and then seeing what that trend is. So you can see this company, and this is why it's good to kind of look at some of your numbers and some of your KPIs and analyze it, because you might think that it's bad because this company actually decreased in revenue growth. But the other side of it, you can see that their total cost of goods actually improved from the previous year. So they actually had less direct costs year over year, even though their revenue decreased. So it's it's a prime example of, sometimes companies take those years, right, where it's okay, this isn't about growth and about doing more volume. It's about really dialing in and becoming more profitable, right, so that you can invest back into your company and continue that growth. So looking at some of the KPIs here, and then also comparing to the industry median, which we'll share some of those metrics with you as well, based on some of the data that we collect. One of the important KPIs, especially as Carl was mentioning, cash flow, and for those of you that look to grow faster, utilizing debt, right? So, but the other side of it too is you don't want debt to turn into a bad thing, right? You don't want to be over leveraged and put yourself in a position where you're struggling to make some of those payments. And just as you would look at it with a home, right, where your liabilities is your mortgage and your asset is your home value. So in this example, you could see under the average U.S. home, liabilities to assets is 44%, right? So 44% of that total home value is made up of that mortgage. So, okay, how do we look at that, but more based on a green industry company? How do we analyze it that way, right, to kind of stay within those bounds? And this is what we kind of see as the averages over to the left, in regard to some of those metrics, right? So, and some might consider, might have a little bit more of a debt appetite and more of a drive to use debt to grow faster, while others don't use it as much. And we work with companies that are profitable in either scenario. But again, it's about using some of the KPIs to help with some of the decision making. So if you're going to be going into a situation where you want to double in size next year, can you actually take on more debt? Or should you maybe take a couple of months to build up your cash reserve and put yourself in a better offensive position? And as we were going over in regard to some of those balance sheet items, if you look at a P&L and we see that, okay, the average install company in 2024, their gross margin was close to around 40%, net margin was around 5.5%. But the net cash flow was 0%, right? Which kind of goes back to when Carla was going over the balance sheet items and the cash flow forecast, right? So it's keeping in mind all of those cash inflows and all of those cash outflows, because that's how you can run into trouble sometimes, And I think it's oftentimes I think as companies grow, you may not realize that maybe if you go from $500,000 to 1.5 million in sales, you didn't run into much cash flow issues, but what you're doing in the company is actually may lead to cash flow issues, even if you're almost doing the same thing, right? So sometimes doing more volume and growing the company could actually make your cash flow situation worse. So it's something to definitely keep an eye on month to month, and even week to week. If you're really managing those accounts payable and AR as well. And then also looking at overhead costs. So for install-based companies, around 32% of total revenue, right? So think about that as all of those expenses that aren't directly correlated to performing the work in the field. So administrative, so whether it's marketing, accounting fees, or administrative staff, utilities, right? So all of those costs, you want to make sure that within those job costing reports, as Carla went over, that you're really accounting for that, right? You don't want to just come away from a job and say, oh, wow, I made a a 50% gross margin. That's fantastic. I think it also depends on what your overhead is, right? Because if you're able to manage your overhead better than other companies in your market, it puts you in a lot better position to win bids and, maintain profitability and pay your people well as well. And then as you scale, this is something that we always try to remind companies of, because I think especially as you start a company or you just continue to grow, sometimes it's easy to lose sight of the administrative help within your company, and some of those people within your company that help to support the main operation. Maybe they're not the they're not the superheroes out in the field that are out on the projects that are producing the amazing work, right? But these people are really important to making sure that your operation is flowing smoothly, right? So, but the other side of it, you don't want to be overpaying on this. You want to stay within maybe 8 to 9% of total revenue. And if you're laying the foundation more for growth, maybe you're a $2 million company, but you want to be a $4 million company in 2 years, maybe you might have to hire a couple admin people a little bit ahead of time in order to not strain your current team, right? So maybe be a little bit overstaffed in some components there. But again, if you're overstaffed and if you're hiring a little bit ahead of time, that might increase risk, right? Because it's going to put that pressure on you, and it'll make it even more important that you do actually hit those revenue goals. Which again is important. Why you need to track these items month to month and hold you and your team accountable to it. And if you're not seeing the numbers that you want to see, making those adjustments. But also giving people a fair amount of time to really show, okay, is this person going to be an effective addition to the team? Giving them the tools and the training to make that happen as well. So, and those were a few examples within some of our reporting. We go in a lot more in depth, and even for those of you that are already Cycle CPA clients, a lot of the stuff that we went over today is kind of like an add-on service, right? So you may not even be seeing stuff like this, and but we want to show you these things to show you what is available here within some of the services. And if you're also kind of out there and watching this webinar here and thinking, wow, this is good, but my books are not even cleaned up yet. I think we also like to approach things sometimes in phases, right? Where it's okay, let's get the books cleaned up, the chart of accounts cleaned up, get you on the right track, and then we can really dial down and come up with a plan to, maybe do job costing, have more of these organized meetings. But in order to do a lot of that fun stuff, you need a lot of those basic fundamentals done first, right? And it's basic, but it's not as straightforward, unfortunately. This is awesome stuff. If anyone has any questions, any other questions, definitely please mention in the chat. So awesome. And props to everyone for making it through an accounting webinar. It's never easy to do that. So, but it means that you're definitely prioritizing the right stuff.
Yeah, thank you, everybody. And if you have any questions or any specific questions that you want to bring up, go ahead and email Joe or email me at carlap@cyclecpa.com. I'd be more than happy to help. But yeah, check out our website at cyclecpa.com to schedule a call. This recording will be emailed to you all. Thank you again for your time. It was nice seeing everybody. Bye.
See you, everybody.